maybe it was Jeff Gundlach that said, and I agree with him, that the Fed is the biggest cause of the wealth disparity in the country because of the inflation they kick out there. To think that you should have a target inflation rate of 3% is rather absurd in my view, because essentially give yourself about 30, 40 years and you're trying to drive the value of the currency down to zero. I mean, it just doesn't make any sense. It comes from a Keynesian concept where if people think there's a little bit of inflation, they'll be more likely to run out and buy something today than to wait for a month or a year or 2 years and buy something. So there's this idea of trying to keep the economy going.
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Ewell. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. I have 3 special free gifts for you over at 10MinuteStockTrader.com. That's the Triple Stock Profits ebook you can get for free. That's a Bullish Power cheat sheet that you can get for free. And if that wasn't enough, at the brand new web class, How to Easily Discover Proven, Back-Tested, 100% plus winners, that is for free as well. You can get these 3 free gifts, all yours, at 10MinuteStockTrader.com. The Triple Stock Profits ebook, the free web class, and the Bullish Power cheat sheet. And all you got to do is go to 10MinuteStockTrader.com. Markets are people. People are predictable. Outlier can show you how to track market fear and greed with artificial intelligence on over 1,300 of the largest market cap names. Visit outlier.com to learn more. That's OVTLYR.com. They have a free pilot program for the rest of 2021, so you can get access to right now at OVTLYR.com. That's OVTLYR.com. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week. Hey there, traders. Welcome back to today's How to Trade Stocks Options podcast. Today, we have a very special guest online. Somebody we've had a couple of times on before, but it's been a little while. Dr. or soon to be doctor, I should say, Mark Guthner from Rutgers School of Business in New Jersey. He's the associate professor of professional practice. Mark, this is very exciting to have you on today. Thanks so much.
I'm happy to be here. And it's nice to be in a position where I can turn into a new career. I'd been a practitioner for about 30 years, and now I'm taking all that stuff that I've learned and did in real time and pass that knowledge on to kids. And then I also help them either get into graduate school or find the job that leads them to the career path that they want. So some of them want to go into sales and trading. Someone wants to be analysts. Some wants to be wealth managers. And I do my best to tee them up so that they can pursue their dreams.
Perfect. Well, I'm really excited today. Mark reached out and he wanted to have a discussion about inflation. And so what I did is I'm like, this needs to be top priority on everyone's agenda. So I bumped our normally scheduled show. So Mark, we're getting this done on Friday and this is going to go out on Monday. That's how fast we're going to turn this around. So
Terrific.
Yeah. So Mark, let's get into it, right? We're looking at unprecedented levels of things that are going on right now. I saw anecdotally that the last time we had inflation at this level, the Fed funds rate, which has been at 0 to 0.25, was at that time over 11%. And
That's right.
This is a crazy world we're living in right now. So I will let you tell me more about it.
Well, not only that the last time this happened, that ET phoned home. What we're going through is extremely predictable if you understand monetary and fiscal policy. So what the government did basically said, go home and don't make anything and don't do anything. So production comes to a screeching halt. And then knowing that that puts huge financial strains on the people that can't go to work, they pay them a pile of money to go out and spend and quote unquote keep the economy going. The guts of an economy are about production, not consumption. Consumption is the reward you get for getting up and producing and making something. So, of course, the Keynesian economists have it all backwards. So naturally, we have this big rundown in supply of goods, and because people are depleting the inventories, and so it was only a matter of time before these supply chain problems came up, and prices started to rise. So just think about that: lots of money in the economy, nothing to buy, or no production in the pipeline to buy. So naturally, we're getting much higher prices. The scary part about all of this is the government is, or I should say the Federal Reserve, has increased the money supply by about 40% in the last, I guess, 24 to 28 months. So think about that. The money supply has grown from 1778 when we became a country. And in 3 years, we did 40% of what was done in the previous 200 and something years.
That doesn't
just
seem
remarkable.
Insignificant. That seems like quite a lot.
It's enormous, and it's an abuse of the monetary system, and it's hurting a lot of people. I mean, you think about on the financial TV shows, people are cheering because it made stock prices go up, and it allowed some young people who never traded stocks before that all of a sudden they got a check from the government, and they immediately opened an account over there at Robinhood and started whipping and driving options and everything else. And that's why we get the AMC and the GameStop stories and other things like that. We're kind of in a very strange world, I would say.
I agree. And that during that time period, let's call it early spring 2020. That was cool, right? For stocks to be able to see the explosive moves, that previously were only held by, crypto assets, right?
Yeah.
But now we're looking at, if we just got 40% more supply of money, does that mean that my dollar should be worth 40% less? Am I reading that right?
Yeah, I think that we will see an increase in the price level of 40%. The question is how fast and how long does it take to get there?
If that's not insignificant.
Is it going to take 3 or 4 years? Say again?
Oh, I was just going to say, that's not insignificant. I mean, I can't imagine paying 40% more for goods and services. That hurts everybody.
Yeah. Well, we've seen the price of cars. Used cars are oftentimes around the same price as let's say, used car that's about a year old is going to be very near the price of a brand new car. My wife works in the car business, and she tells me it's pretty common for people to have to pay $5,000 over sticker price because the dealerships don't have any inventory.
Yeah.
So it's their way of sort of rationing inventory and keeping a little bit around for their best customers. But everybody's paying way too much for cars and food, and we're seeing it in gasoline now, right?
Mm-hmm.
And housing prices. I think Zillow was saying rents are up nationwide around 20-ish%. That, by the way, contrasts with the government's figure, which is something like 3 or 4%, because they do a thing called owner's equivalent rent, which they take a survey. There's no reason to do that process anymore because Zillow can give you keeps track of these things nationwide in real time. So, but in any event, real estate prices have gone up. We've seen that, not uncommon for a lot of places, real estate to go up by 20% in some of the big cities. Your state of Texas is doing quite well in the real estate category. So yeah, everything's going up, and it's going to cause a lot of stress. There's no question about it, because I don't know anybody that's getting a 10% increase in pay. I haven't met any of those people yet. So households are about to get really squeezed.
And 10% doesn't feel like it's going to make that difference, right?
Yeah.
That 40% money supply. At 10% is very generous, but I don't think that's going to make the difference.
Yeah. So the question is how long do we get there? We could get a, 7, let's say, just say 10% for easy numbers. It'd take us 4 years to get to that new price level. The Fed is doing a lot of talking right now about tightening. But really all they're really doing is, at this stage of the game, taking their foot off the gas pedal a little bit. There's still no tightening going on. Although board member Bullard yesterday mentioned that, 50 basis point hike, which is sort of the accepted number that's going to come out and the Fed's going to do in some short order. He was saying that, that doesn't mean anything in this kind of environment. And that was in response to yesterday's CPI number, where it came in 7.5% year over year, which is an enormous number.
You said 50 basis points doesn't mean anything in this environment?
Doesn't mean any, a raise in rates of 50%. He said this, not his words, not mine.
That's the biggest rate jump we've seen in a decade or more.
Yeah, no, they've always moved by these little itty bitty moves. And these are, when I started trading bonds 30 years ago as an institutional bond trader and portfolio manager, interest rates, the 30-year bond was, I think, about 14%, and it routinely moved by 4 or 5 points a day. So
4 or 5 percentage
I know
points?
what volatility looks like. And nobody that's in this business for the past 10 or 15 years knows what true volatility in the bond market looks like.
So you're saying it was around 13 to 14%, and then would move a figure of 5 percentage points?
Yeah, Dave, was not uncommon.
That's crazy.
It was not uncommon for 30-year bonds. Yeah, for 30-year bonds. So
how do you run a business?
It was actually a very fun time to trade bonds, because I used to do a lot of yield curve arbitrage.
Yeah.
And I just scrape money out of the market sort of day in, day out for my customers.
How does an institution that needs to borrow do business when rates move that much? That seems crazy.
Well, what you got to do as a business is you lock in a long-term rate, and it's like, if you can live with the payments you got to make, and you've got the EBITDA, the cash flow to cover it, then you're fine. You lock in a rate. There's, from the standpoint of corporate finance, you want to finance your long-term assets with long-term debt and equity, and your short-term assets like inventories and receivables with short-term debt. So if you line them up, you'll manage your interest rate risk reasonably well. So that's not an enormous problem. But banks, are going to have a challenge, because they're rich with cash, and they got to figure out where they're going to invest it. And banks need to invest in short-term assets, because their liabilities, i.e., deposits, can walk out the door at a moment's notice. So they can't lock in any long-term rates, and they certainly wouldn't want to in this environment, where I think interest rates are going to start rising at a surprisingly rapid rate.
So if interest rates start rising at a surprisingly rapid rate, for me as an individual, as a consumer, where am I going to be impacted with that? Because that sounds scary, right?
Okay. Yeah. So one of the things I tell all my students is I lived through, I should say, interest rate cycles are very long. They go on for 30, 40, 50 years. So we saw interest rates rise from the early 40s into 1981, 1980, right around there. So call that 40 years, and add 40 years to that. And here we are at 2020. And now we're going to go on another 40-year rate rising
I hope not.
Well, it's just in the cards. The thing is, it's just going to go on for a long time, and it will be relentless unless something remarkable happens in the financial markets and the way our money is structured. So, Bitcoin throws a monkey wrench into that analysis a little bit because most of us don't know what's going to happen and how that's going to impact, savings, payment systems, how we price assets going forward. It's going to have an impact, but it's unclear what that impact is. It's too young, and a lot of minds need to be brought on to think about how that's going to happen.
Yeah. So, going back to the car situation for a minute, thankfully I've not been in a position where I needed to buy a car over the last couple of years. But at this point, our family has decided that we want to go buy a Tesla, and that's an exciting thing. And around here, there's lots of access to charging points. There's a Tesla service center 10 minutes from my house. So it doesn't seem like that big of a hassle for a day-to-day car for us. Mm-hmm. And my neighbor, he just bought a Model S, and this is not me trying to keep up with the Joneses. He did his thing, I did my thing. That was funny, but he just bought a Model S, and he was telling me that he was looking for used, and he found he could get a new one for less than a used one and still get his tax credits. And I saw the exact same situation for me, because I'm waiting for the Model Y. Model Y is supposed to get new batteries. And so I'm like, I'm going to wait for the new batteries, right? Because I want the better batteries. And I was pricing the Model Ys, and I'm like, I can save $5,000 versus buying a used one, and I'll get the tax credits. I don't even understand what's going on right now. Like, something's broken. And what is it going to take to fix this, right? This is an unusual environment. What is it? The supply chain? Is it, what's it going to be?
Everybody's got to get up, go back to work, start making stuff. And that kind of thing. I think a lot of people have more money to spend because they saw their stock portfolios go up. If they're a homeowner, they saw the price of their house goes up. And, we as Americans love to refinance our house, take that chunk of money and go buy something big with it. And I think that's what it is. I think we're seeing a big chunk of this wealth effect where people feel more wealthy because their stock portfolios went up. I think the triple Qs doubled from the COVID low, or
everything did. Yeah, even the SPY S&P did.
Yeah. So if you were in stocks, you're feeling pretty flush right now. If you're in a house, you're doing okay. I think what's happened is tragic government policy, because about 50% of our friends here in the United States do not have stocks and real estate. They're living in apartments, and their incomes aren't high enough for them to accumulate assets, and so they get left behind. And they're the ones that really get hurt by this inflation a lot, And I forget who it was. Maybe it was Jeff Guthner that said, and I agree with him, that the Fed is the biggest cause of the wealth disparity in the country because of the inflation they kick out there. To think that you should have a target inflation rate of 3% is rather absurd in my view, because essentially give yourself about 30, 40 years and you're trying to drive the value of the currency down to zero. I mean, it just doesn't make any sense. It comes from a Keynesian concept where if people think there's a little bit of inflation, they'll be more likely to run out and buy something today than to wait for a month or a year or 2 years and buy something. So there's this idea of trying to keep the economy going. I think it's an erroneous notion, but it's what the people that have their hands on the controls believe, and so it's our job as people, citizens, to try to work our way around that and say that's a given. So what do we do to survive in such an environment?
So how does the Fed cause inflation? Like that kind of, or does the Fed cause inflation? Or
Well,
I guess, how does the Fed fight inflation?
Well, the Fed is the principal cause. The banking industry helps. But the way inflation in its proper term is the growth in the supply of money and credit. And the way they increase money is they buy treasury securities. They go into the marketplace. They call their friendly neighborhood broker, Goldman Sachs, Bank of America Merrill Lynch, Wells Fargo, all these what are called primary brokers. They're the ones, there's about 22 or 3 of these now that trade with the Fed. So the Fed basically buys a treasury security from a broker and then just deposits money into their account, and they create the money out of thin air. So they don't have any money. They create a liability. That's what a U.S. dollar is. So if you pull out your wallet or purse, take a look at a currency. On the top, it says Federal Reserve note. A note is a loan. In the case of a currency that sits in your wallet. So that's what you'll hear Powell talk about this. And he's really the first chairman that really that talks about money as being a liability of the Federal Reserve Bank. So they issue a liability and then they go buy an asset with it, a U.S. Treasury bond. So the supply of dollars out there increases every time they go and buy a Treasury security.
Mark, can we do that? Can we make up something, then go buy it for free and then just call it a day?
I'd like to. If you can figure it out, clue me in.
Oh, okay. Very interesting.
Yeah.
I tell you, sometimes you might sit back and say, this is awful. But at the same time, you kind of sit back and say, well, this is kind of cool to live through. Got some great stories that we could tell through it. So yeah. Where can we go with this, right? So you brought some slides. I'm really curious to see what those are and to talk more about them. Okay,
I'm going to share these slides with the viewers here. And I want to talk about this, and I talk about this. This is a short synopsis of an article I wrote on my website called theoptionsedge.com. And we talk about options trading strategies, stocks, investment environment. There's a lot of educational material in there. And I share some investment thoughts, some trading thoughts with our paid subscribers. But I put up a fair amount of free content as well. So this is one of the pieces that I did because I think, and this is, I teach a class in asset valuation. And so this is a little synopsis of what are the things I talked about in our classes. And so I want to talk about why I think equities are overvalued and equities are overvalued because I don't think the world appreciates the inflation problem yet. Well, so my thesis.
I'm going to stop you real quick. Just so we're on the same page. When you say equities,
stocks,
just stocks, or does this include any sort of asset like a home or?
Yeah, you could the same principles apply to a home, but for this example, I'm just going to talk about stocks. Sure. And my surrogate for that is the S&P 500.
Okay.
And in spiders in particular. Okay. So my thesis is that U.S. equity prices don't incorporate sustained inflation in their current prices. And so we saw yesterday the CPI year over year is up running at 7.5%. That's very hot. I think it'll be high single digits going forward for a while. There are some folks out there that are saying that they expect it to go higher than that, low double digits. I was listening to some of the financial news yesterday, and there's a lot of people still arguing. I would say the consensus view at this stage is that this is transient, and it's because they're just pointing at the supply chain problem, as if that's some sort of a broken wheel, and once you fix the wheel, it's going to go be okay. And as I talked about earlier, we have the supply chain problem because we stopped production and then inflated the money supply, gave people lots of money to spend, and they want to buy more stuff than there is stuff. And that's why we have shortages of everything. And it's also true that, a lot of, especially if we stop producing things in the US, well, where do we get the stuff we buy? We get it from overseas. And that's why you see the ports all clogged up and everything else.
So I had somebody on the podcast about a year ago when the whole inflation talk started, and they explained it to me like you were just saying, right? Once we get everybody back to work, once we get all the workers in the factories and everything turned back on, then this idea of inflation being transitory would hold true, and everything goes, quote, back to normal. But we're 2 years deep at this point. We don't know if things are ever going to go back to quote unquote normal. Do we still feel that inflation is a transitory thing? Like,
well, I'd say that the consensus view right now is yes, that it's transitory. It's my view that it's not. Milton Friedman told us that inflation is everywhere and always a monetary phenomenon. So if you increase the money supply faster than goods and services, you're going to get higher prices. He was both a free market economist and a monetarist. And some people don't think of, they think monetarism has been discredited. The problem with monetarism is it does tell you if you grow the money supply, you're going to get inflation, but you don't know when, because to get inflation, you need two things. You need the growth in the money supply, and then you need people to want to get rid of the money they have. So if they start to fear inflation, then they start dumping their currencies, buying real assets, and then the higher prices begin to show up. So you need sort of the fuel to get there, and then which is the growth in the money supply, and then you need a change in attitude, which represents the match to light the inflation. So that's the way I think about it. So you could have, in theory, a growth in the money supply for 5 years. And in fact, I would say this is really what happened after the financial crisis. Is money supply grew very fast, but people were concerned. So what did they do? They hoarded money. They paid off some debts. They didn't run out and spend this money that was being created. And so we didn't get high inflation rates, but and most of that money flew into the financial markets instead, pumping up the price of bonds and stocks, and people saved it. So once people turned the switch and said, I'm going to start buying stuff now, they started to drive up the price inflation rate.
Yeah, that makes sense. But it sounds like there isn't a cure for this. It sounds like we're stuck.
Well, the cure is to stop printing money. If you wanted to stop the inflation that's going to come in the next few years, you would have to pull money out of the system. And what would that do? You would take a lot of fund managers that have borrowed to the hilt to buy securities, because when interest rates are super low, you encourage people to borrow and buy an asset. That's what happens in real estate. The bond hedge fund guys, they play the carry trade. They borrow at 1 or 2%, then they go buy high yield bonds at 4 and 5 and 6% and collect the difference. Interesting notion right now is that the yield on high yield bonds is less than the inflation rate. So you think about that. Even if you get your money back, you're going to lose purchasing power. But a high yield bond has a high propensity or potential to default. Makes no sense. As you can see in my little chart here, HYG, which is the ETF that tracks high yield bonds, only yields 4.2% right now. which is less than the 7.5 that we're experiencing right now. And as you also notice here, the 10-year bond is only a 155. So the guy that owns a 10-year treasury bond is losing about 6% of his purchasing power every year. That's harsh.
So how do we pull money out of the system?
So what the Fed would then do is they would sell securities. And so when they sell securities, that they get their Federal Reserve notes back, and then that shrinks the money supply. They reduce their balance sheet.
So
they reduce
it's like
the amount of currency outstanding.
So let me try and understand. So they buy the security with fake money that they made.
Yeah.
And then when they're done with it, they're going to sell it back to that party, call the transaction even, and then that money that didn't exist in the first place disappears.
Yeah, it's like repaying their notes.
Yeah,
they're going to repay their Federal Reserve notes. They retire those securities. And so they're gone. So it's the exact opposite way. But there's never been any time in the history of the Federal Reserve where they have, for any sustained period of time, sold securities since 1913. So there's a lot of talk that they'll do that, but when everybody is partying with cheap money, you take the cheap money away, a lot of dislocations are gonna happen.
It's almost, since you teach at Rutgers, it's almost like the party with cheap alcohol.
Yeah.
Cheap tequila. They show up with cheap tequila. Once all the cheap tequila's gone, everybody leaves, right?
Yeah. So that's the old adage for the Fed. If you had a real investment bank, a real central banker, your job is to take the punch bowl away when the party really starts getting going.
Okay.
And instead, they were spiking it more. Trying to extend the party into the wee hours of the morning.
So do you think
that they're kind of trapped right now?
Well, I was about to say, do you think that they messed up?
Oh yeah. I think the policy errors, but in the last 2 years have been gigantic. If you did not want to have these huge dislocations, and you're telling people not to go to work, what the government should have done is said, people, you're going to have to consume less. Where you're making less, so there's going to be less to consume, so consume less. They did the opposite. They said, make nothing, consume more, shortages of everything.
Yeah.
So if they said you're going to be producing less, you should consume less, and that's going to keep the system in balance. So the system is really out of balance.
Okay, that makes sense. So where do we go next in your slides there?
So this was my thesis that the inflation is not incorporated into equity prices. And so I'm going to look at intrinsic value of stocks. And what is intrinsic value? It's the present value of the cash flows that go to equity holders. And what they get is they get dividends, they get share repurchases, they get asset sales. That cash flow generally flows to the equity holders. So I'm going to walk you through a 5-minute MBA in finance to see that you're here. One of the things that the super low interest rates have done is convinced everybody to put their money in stocks. So lots of retired people, let's say you're 65 years old, most people of that age would have, let's say, 30% of their money in equities, 60% in bonds. Because they're likely to still live another 20 years. They need some growth on their money, but they need steady income to live off of. Because interest rates have gone to bupkis, they need higher returns, so people would sell their bonds, and so their portfolios look more like 60-70% stocks, 30% bonds. And of course, that's helped elevate those prices. So what I want to do is just take a note here. What is present value? What are these concepts? This in one slide, this is finance. It's how do you equate a dollar in the future with a dollar today?
Okay.
So the present value of a currency today is that dollar divided by the rate of interest that you could get in the marketplace. So here, there's a little example. What is $100 worth today if we have to wait 5 years to get our hands on that dollar, and the going rate of interest is 5%? So what I do is I take $100 and I divide it by 1.05%, 1 plus 5%. I compound it 5 times, and that tells me I should be indifferent between having $100 5 years from now or having $78.35 today. I should be indifferent between those two things. So that's what finance is, and everything. And everything is complicated about finance. When you're trying to figure out a stock, well, what is your cash flow going to be, and what is the appropriate discount rate? It's what the whole argument's all about. Mm-hmm. And that's why people think about the economy, business strategy, all these kind of things that will generate cash. So if we're going to look at intrinsic value of a stock, we're going to get cash flows year after year after year. So you got next year, we're going to get a dividend or maybe a share repurchase. We're going to 2 years from now, we're going to get another cash flow. 3 years, we're going to get another cash flow. And that's going to go on, in theory, forever, right? There's no ending life of a corporation, no theoretical ending life for a corporation. So if we thought of a corporate equities as being sort of like a bond with a variable cash flow, that would be the present value or the intrinsic value of that stock. This is the Warren Buffett way. Mm-hmm. So let's say we make an assumption that we know what the cash flow was last year, paid in the last 12 months. And let's just make the assumption that the growth rate from every year here on out will be the same. It's 4% every year, year in, year out. You get this big, ugly, nasty, sort of long equation that goes on forever. So you get the cash, this C1 is equal to last year's cash flow plus some growth divided by 1 plus the appropriate discount rate. After 2 years, we're going to get 2 years of growth. So it's going to compound twice. We're going to discount it twice. It's going to bring it back to today. So that's a nasty calculation to deal with. But the reason why I assumed that a constant annual growth rate is with some mathematical gymnastics, we can say the intrinsic value boils down to this little equation right here, which is the cash flow for the past 12 years times 1 plus the growth rate. And then we're going to divide that by our discount rate, the rate at which we should get a fair rate of return, minus the growth rate. So with this equation, we can figure out the price of stocks. So what do we need to do? The first thing we need to do is figure out what's the appropriate discount rate on stocks. What's the appropriate rate of return we should expect to get on average year after year by holding the S&P 500.
And so example, that generally comes around 9-10% or so as like the average. But you're saying like what's the should be number, right?
Yeah. So if we go and look at the last 100 years, the average rate of return on the S&P 500 is about, you're right, about 10, little over 10%, right about there. And what I always tell my students, back of the matchbook, the rate of return on stocks, expect 10% and with a volatility of returns of 20%. That's historically what's happened for the past 100 years. I'm not going to get into volatility here too much. I just want to get at a point estimate. So how do we get to an appropriate discount rate? So what I did here, and this is standard capital market theory, is if you have a stock, you're going to get some risk-free rate. So if you owned treasury bills, that's the rate that you get. If you're going to step out on the yield curve, you should get some risk premium for that, right? So what I did is I went back here to 1928, I think it starts, my data set. Maybe it's 21, I forget my data set. About 1928. So I looked at what was the equity risk premium. What is that? That's the rate of return they actually got minus the risk-free rate. So this is the premium that you would get. And this is a rolling 10-year average, this blue line. So you can see there's a big cycle in that. Now, if we averaged it over 30 years and did a 30-year moving average, it's a lot more smooth, and you should expect it to be that. That's the red dotted line.
Okay.
If we averaged it over 50 years, it's this black line. And as it turns out, over this entire time period, it's about 6.47%.
So that's the rate we would need to get.
In addition to the risk-free rate.
Oh, okay.
To get an expected return on stocks.
Okay.
All right.
So really the 10% or so is outperforming this number? Am I reading that right?
Well, remember, there were periods of time when we had 8, 9, 10% risk-free rate, and you should still get more than that, right? On your equities, a risk premium for that. So we've gone through periods of time when the rates of return were much higher than 10%. And of course, rates times when they're lower. Great Depression, rates were lower. Not the 70s. The 70s were a tough time period. The Dow Jones Industrial Average did not change in price from 1970 to 1980. Your total rate of return for 10 years was 0.
Whoa. Never thought
there were two huge swoons. One, I think it was 73, where it went down about 55% in a matter of a month. And I remember that year because as a young boy, teenager, I used to talk stocks with my dad, and when I'd drive, he'd have me read the newspaper and look up stock prices for him. He got clobbered, in that time period, as a lot of people did. Warren Buffett got taken to the woodshed. If you go look at the old returns of Berkshire Hathaway, they got clobbered in, I think it was 72 or 3, came roaring back in, 74, 75. And then there was another big dip, I think it was in 77, and then it came back. So a lot of volatility in that decade, but no net progress. So in any event, what I wanted to know was, what is the equity risk premium on average? So it's about 6.5% looking back. So if you take some risk-free asset plus a risk premium, what should we expect to make going forward over the next, 5 or 10 years on a per annum basis? And that's about 9%. All right. So now I'm going to just pop all these numbers, some numbers into this formula. I went and looked up the average dividend growth rate in spiders, SPY, since 1990. That was 5.62%. So I'm going to make the proposition that let's just assume dividends grow at the same rate going forward as a first step. What it did for the past 30 years, let's just assume it's going to continue at that pace. So the dividends paid over the last 12 months was $5.72. I got my discount rate of 6.87, and my investment time period is forever.
Sure.
So I just put the numbers in that formula, and I get a fair price, a valuation of spiders as $483. Well,
that's below where we're at now.
Oh, that's a little above where we are right now.
No, we're at 443 at the moment.
Yeah. 483.
I'm sorry. I said it backwards. Yeah. Yep. Sorry.
Yeah. So when I first did this and posted my article on the website, they were very close to the same thing. In fact, I was shocked how close they were.
Yeah, because the high was roughly around that point earlier this year. Right.
Yeah. So I wrote this article in I think January 1st or 2nd, sort of like, here's what you can look forward to the year ahead. So it's about $440. So number of potential conclusions you can make. You could say stocks are underpriced by 7.4%. We could say that investors are underestimating growth rates by 9 basis points a year. We could assume that the discount rate was maybe too high by 9 basis points. Or maybe investors are assuming that the dividend rate going forward would be is 39 cents less per share than what this model would predict. So there's a little bit of wiggle because we're estimating every number that goes into the equation we have to estimate. So, but this is pretty good. It tells us, it gives us a framework to start thinking about what it should be priced. Now, the second thing we should think about is the risk-free rate. What is a fair rate of return for the risk-free rate? So if your inflation rate is 7.5%, and you're facing an income tax rate of 25%, then what would be a fair yield on treasury bills? Well, the way we do that is we take the inflation rate, we divide it by 1 minus the income tax rate, and we get a rate of return of 10%. If I was an individual investor and I wanted to get a zero real rate of return on my money, I would need to be earning 10% on my money right now.
No way.
Yeah.
That's like impossible.
hence people not running, but diving into Bitcoin.
Yeah. Okay.
Yeah. So this is one of the things that from a game theory standpoint is the Fed has to do something here. Otherwise, they're essentially accelerating this move into some other currency. I just saw a new company, and what they do is they print currency bills, and they nanoparticleize gold, and they spray it into the paper.
Oh, that's cool.
So you now can use a piece of paper that represents a certain amount of gold as a currency.
Kind of like the $20 gold eagle or whatever it's called.
Yeah. But this is paper money now.
Huh.
This is not a coin.
Yeah.
I just stumbled upon that. And I thought, well, that's sort of an interesting idea. They figured out how to nanoize gold and then infuse it into paper. And so the paper itself actually has gold in it. And so who knows, maybe we go back to a gold standard.
I don't know. At this point, it sounds like we need to do something.
Yeah. So, but now I am not predicting that rates are going to 10% in the next year, 2 or 3 or 4 or whatever. I'm not predicting that. I think there's still going to be what's called financial repression. I lend the government $1 and they're going to give me back 95 cents on the dollar in terms of purchasing power. I'm going to lose purchasing power. So of course, if I had to get that 10%, now the rate of return I would need on stocks to get a fair rate of return is 16%. Now, if you flip that upside down, that represents a price to earnings ratio of about 6. Price to earnings ratio of stocks right now, looking backwards, last 12 months is like 32 or 3.
Right.
Looking forward, it's about 21. So that would imply, a fair sell-off. Now, again, I am not predicting rates going up to 10%. This is sort of a little bit of an exercise on what is possible. There's another way to look at this, and we'll highlight the sensitivity of stocks to interest rates when interest rates are so super low. Again, our inflation rate's 3.5%, but if we looked back since the year 2000, the average inflation rate has been 2.25%. If we do the same analysis and say 2.25 divided by 1 minus the tax rate, that means a fair rate of return on treasury bills would be 3%. So let's say that I believe is a very conservative number. I can see treasury bills rising from where they are now, which I think is about 25 or 30 basis points, to 3%. That's far lower than the historic average for the past 100 years. But that's a possibility.
And that's not even close to the 10% we were just talking about a minute ago.
Yeah. So it's like, okay, let's not lose our head here. Let's not, let's not take a look over the ledge. I still think we're going to, like I said, have financial repression. I don't think people are. What would drive rates to 10% is if everybody was convinced inflation was going to be 7.5, 8, 9 forever. Then it would like, okay, people would say, I'm going to go borrow as much as I can and go buy stuff.
Yeah.
And take advantage of that inflation. And that's partially what happens in the real estate market.
Well, hang on. If they did that, would that be somewhat of a similar situation as to the Fed buying these treasuries with non-existent money, right?
Yeah, sort of.
Yeah, no. I can see that parallel.
Yeah. So corporations and brokers and stuff, banks would be able to do this far easier than you and I. I don't know about you, but if you go to a bank and say, I'd like to have a personal loan, they'll probably charge you 7 or 8%.
I don't know. I've never walked in and said, hey, give me a personal loan. Thankfully.
Yeah. So if they were willing to if they thought you were good credit, they would probably charge you 7 or 8%. That's probably around what you would pay for a second mortgage, perhaps.
And that's an unsecured loan, right? So that's going to have a initially higher rate than a mortgage or an auto loan, right? And
if you think about the classic unsecured loan is the credit card, right?
Right.
And so they charge anywhere from 9.25% to I've seen as high as 48%.
Cool.
In any event, let's step away from that for a second. So now what I'm going to do is I'm going to use 9.47% as my appropriate rate of return on stocks. So all I'm going to do is change that number. The fair value of stocks falls from 483 to 157.
That's not a little bit. That's a lot.
That's a huge amount. Yeah.
That's 2/3 basically.
Yeah, it's a clobber. So you think about that. Rates change, but the economy still kind of moves along okay. You don't need a market. You don't need an economic dislocation for this to happen. What I don't know is that if inflation is higher, maybe this growth rate is higher. Maybe that turns out to be 7 or 8%, right? Because if you think about if I'm a business and I can hold my margins constant, which a lot of businesses are going to have a hard time doing with inflation moving higher. But if my revenue goes up by 10% and I'm holding my margins constant, my free cash flow is going to go up by about 10%. So that's the thing I don't know. So what I surmised was maybe rates go up to something like the growth rate increases to something like 7 or 8%. So now we're talking about a potential downside range of $250 to $420. I realize that's a wide window, but I have no idea at this stage. I don't have a good way to model what corporate earnings and cash flows are going to look like as the inflation rate stays high. As software companies, for example, should not be very highly impacted. The reason why is that they've made their product and their cost of goods sold is essentially zero. You just copy the software.
Right.
Or if you're a cloud company or something like that, what do you pay? Well, you're going to have to pay a little bit more for electricity or something like that. So those kinds of businesses are likely to be somewhat immune. But you think about a car company. Let's say you bought a car company makes a car for $25,000 and then sells it for $30,000. So they make $5,000 profit on the car.
Sure.
And then let's say they pay a tax on that. And so that reduces their after-tax cash flow to $3,750. Now, what does it cost to go make a new car? Well, that $25,000 car now costs 10% more. So your new cost of goods sold is $27,500. And so you don't get to keep that $3,750. You got to roll $2,500 back into your old inventory.
Right.
So you get a small bit of cash flow. So manufacturing companies are really hurt hard in an inflationary environment because they make profit and then they've got to go out and buy raw materials at higher prices. They don't get to pay out their profits to shareholders in as large an extent. So there's going to be a mixed bag. I think those that, if you're going to invest, think in those terms. Look at companies that tech oriented that have really low cost of goods sold, and software is the first one that comes to mind. Others, you just got to look around for doing that. There's still going to be good stocks that are not overpriced. I just wrote an article on Goldman Sachs. They're trading at about 7 times trailing earnings and about 10 times forward-looking earnings. Perfectly good stock to buy in this environment because they're preeminent traders and they're going to make more money in volatile markets. So I expect them to keep up. Who do I think is going to get hurt the most? Probably your Cathie Wood style companies that are not going to turn a profit for 10 years or 5 years because you've got those cash flows way out in the future and they're very uncertain cash flows. And you're discounting those back today at a higher rate. So those are the kind of stocks that I think are the most vulnerable in an environment in which inflation is sticky and stays high and not transient.
Right.
So that wraps up my whole little talk on this little thing. So my potential conclusion is I don't think at current prices, investors are thinking about and including a persistent high inflation in going forward. I don't think treasury bills reflect the possibility that fixed income investors may someday demand a reasonable rate of return. Stop ripping me off. I mean, if I had my money sitting in a bank or a money market account, I would be thinking long and hard about putting some of it in Bitcoin. And then some in some really cheap stocks, like I just mentioned, Goldman Sachs. But there are other stocks out there that trade at single-digit price-to-earnings ratios that I think come through this kind of tough time okay, and still an investor can make a buck. But I think there's going to be a huge game of people trying to figure out that the super hyper growth stocks that did so well, particularly from the COVID bottom to today, are the ones that are going to get hurt the worst. We got some examples of that. Peloton is not making the transition. Haven't been able to make they've super hyper growth but can't get the cash flow out of it. Maybe with new management they can. Time will tell. But look at Zoom. Are you on Zoom? Zoom stock is down a lot because their growth rate is going to bupkis. If you needed Zoom services, you have them. So how do they grow revenue from here? At the margin, some people will be canceling because they'll have to go back to the office. And stuff like that. So and so these stocks are down a lot. That did so well during the super growth period.
So Mark, what's our takeaway here, right? What can we do defensively or offensively to work with what we're given, right? We can't control the external environment, but what can we do in the short term and maybe medium term to help ourselves?
So what I think you do is I think you focus on value stocks, and growth stocks have basically been the winner in the last 4 or 5 years in a big way. Interestingly, if you go back 100 years, value stocks have outperformed growth stocks.
Now,
and
real
fairly
quick,
steadily.
when you say value stocks, you mean like the blue chips, like the grandfather stocks, or do you mean something else?
Yeah, value stocks, they tend not to grow very fast. They're mature companies, but they have some kind of competitive advantage. So you think of a Post cereal or Kellogg's cereal. We're all eating cereal. We're not eating more cereal, but we're all going to eat some cereal. Kids are going to eat the cereal. And so they got a good, steady business. And they're just going to pass through the higher cost of rice and wheat and stuff, oats to their customers. Companies like Procter and Gamble, we're going to buy their products forever. The question is whether or not you can get the stock, kind of cheap enough, because it doesn't grow very fast, but it's got a super low cost of capital.
Right.
But value stocks are those that are not going to be disrupted in some way going forward. And they trade at, in my mind, in this kind of environment, price to earnings multiple of, 12 or less. Is so a company that's got competitive advantage, not going to get disrupted and put out of business, is going to be around 20, 30, 40 years from now. Berkshire Hathaway, fine. It's filled with lots of good businesses that throw off lots of cash, and it's reasonably priced. So those are the things that you want to be in. You might want to start thinking about writing some call options against your stock positions. To build a little income. Yeah, and those provide a mild hedge. If you're protected for 2 or 3 point, 3, 4, 5% down move. If you sell, depending upon whether you're at the money or out of the money.
Sure.
That's one way to hedge yourself a little bit. Aggressive people might want to buy a put spread, might want to buy puts outright. On our website, it's an extremely rare day that we recommend buying options outright because we want to manage that time decay on our options positions. So we tend to like to do spreads so that we have an option that's losing time value at the same rate as, and we're short that as the one that we're long.
Right.
So we tend to like to use spreads to manage that time period. We do a lot of and it's Mike, my partner, Mike Coe. One of his favorite structures are diagonals, where you buy a long-term option and you sell a short-term option against it. And that short-term option tends to decay faster than the long-term option. So you might, over the first month or two of that trading position, not have any time value loss in your option. So he likes those kind of structures, and they require some management. So it's just not a buy and put them away or situation. Once that shorter option is going to come due, you've got to decide: do you want to close the position, sell another short dated option, let the long dated option ride? You've got other decisions to make after you make that first decision.
Right. Well, I'll tell you what, this has been insightful, enlightening, but not exciting.
No, I'm pleased to see you don't. I'm pleased to see you don't have too much sweat coming down off your brow.
Well, I keep a little napkin right here because I mean, my forehead's shiny enough already. I don't need any extra of that.
Well, tell me about that. So, but what I really want to share with people is that equities are fully priced, and so don't look for equities to be your salvation in general. we're going to go into a period now where you've got to be really a good stock picker. Just buying the index fund, which is kind of interesting. I think something like 55 to 60% of all money invested in the equity markets now are in index funds of one kind or another. The people that are going to win are the ones that do their individual security analysis and focus on low price stocks and what I mean by low price, low PE stocks, value stocks that have a competitive advantage. I think that's the way you navigate yourself through, that you get a rate of return that compensates you for risk and the inflation that's in the economy right now.
Yeah. Well, I'll tell you what, this has been great. I really appreciate you taking the time out of your busy day and, taking time out of your coursework there to come and hang with us. So thank you so much for that.
My pleasure.
And we want to make sure that everybody checks out the article and theoptionsedge.com. That starts with theoptionsedge.com. The article that Mark was mentioning is going to be linked down below, and that'll take you straight over to his website. So Mark, thanks so much for coming on and having this discussion today. I'm really glad you did. This is great timing. And hopefully we can all make it through this together with as little damage as possible.
Yeah, great to see you again, Chris.
Yeah, you as well. Well, thank you for coming on, and thank you guys for tuning in to today's How to Trade Stocks and Options podcast. Make sure you like, subscribe, and enable notifications. That way you never miss any of the tools, tips, and tricks that we upload every single week to help you trade faster, trade smarter, and I'll see you on the next episode. Okay, so what'd you think? That was pretty incredible, right? I have 3 special free gifts for you over at 10minutestocktrader.com. That's the Triple Stock Profits ebook you can get for free. That's a Bullish Power cheat sheet that you can get for free. And if that wasn't enough, at the brand new web class, How to Easily Discover Proven, Backtested, 100% plus winners, that is for free as well. You can get these 3 free gifts, all yours, at 10minutestocktrader.com. The Triple Stock Profits ebook, the free web class, and the Bullish Power cheat sheet. And all you got to do is go to 10minutestocktrader.com. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.